This week, 3 trends reverse mortgage professionals should look for in 2023. Welcome back to the Industry Leader Update. After a turbulent final quarter of 2022, it's natural to ask, what can we expect in 2023? And the honest answer would be anything. However, there are 3 trends that reverse mortgage lending professionals will want to watch in the new year, and they are interest rates, home values, and inflation. The central bank's effort to stem the problematic and persistent, it wasn't transitory, inflation has resulted in a series of historic interest rate hikes, and those rate increases have stalled the U.S. housing market. In fact, it has pushed it into what many experts are now calling a housing recession. Now, it's not surprising considering that the Federal Reserve's rate hikes have resulted in the average 30-year fixed-rate mortgage more than doubling from roughly 3% a year ago to around 7% this year. The more important question for mortgage pros is where the 10-year Constant Maturity Treasury rate will likely move in 2023, I should say reverse mortgage professionals. And the global business intelligence agency KPMG Economics expects that the 10-year U.S. Treasury note to peak around 4% in the second quarter of 2023 and then fall to approximately 3.3% by the end of next year. Now, of course, as you know, that rate is the key index used to establish the HECM, or the federally insured reverse mortgage's expected rate. That determines just how much money a borrower may qualify for. Now, looking at the 10-year CMT index, it really whipsawed from a high of 4.25% in late October to 3.5% last Tuesday. But more concerning, however, are 2023 lender margins, which hinge heavily on secondary market demand and also expected profitability. New View Advisors partner Michael McCauley's recent comments to Reverse Mortgage Daily may actually reveal a silver lining. He feels that lender consolidation should resolve some of the earnings pressures that HECM mortgage-backed securities issuers are now facing. The next indicator to watch: home prices. Now, after months and months of cheering on a deteriorating housing market, now experts are acknowledging the housing market shift. In fact, many are calling it a housing recession. KPMG's December edition of its Economic Compass forecasts that the S&P CoreLogic Case-Shiller Home Price Index will drop by 20% from the fourth quarter of 2023 when compared to the fourth quarter of this year. And some metros have already exceeded that forecast in their month-to-month home price sales declines. Now, previously, red-hot markets such as Boise, Idaho, Austin, Texas, and Phoenix, Arizona, they have proven to be the most vulnerable to price drops. In fact, in Austin, nearly 2/3 of home sales listings have undergone a price reduction, and other markets are seeing very similar trends. Now, the Fed's rate hikes, also coupled with bloated home prices that remain too high, in my opinion, have pushed housing affordability to its lowest level since the mid-1980s. Now, those pressures could push home prices closer to their pre-pandemic levels ultimately, and thus rebalance the housing market. And one encouraging finding in KPMG's report is a stunning, that's the word they use, 40% of homeowners, they've paid off their mortgages. Now, that, of course, speaks to the untapped market potential of reverse mortgages, which still remains today despite higher interest rates. Then comes the last factor, the linchpin, inflation. The Fed's interest rates are going to continue until inflation can be pushed down to the central bank's target rate of 2%. Now, to accomplish that, the Fed must carefully push our economy into a recession, ideally what economists call a shallow recession. KPMG expects the unwinding of supply chain problems, falling commodity prices, and also a drop in home values and rents will slow the Personal Consumption Expenditures Index, or the PCE, faster than the Fed forecast. And if that does come to pass, KPMG expects that the Fed will pivot to aggressive rate cuts in 2023. Now, that in turn would reduce the HECM's expected interest rate, and that would increase available funds for new borrowers. Now, The question is for you, what factors do you suggest that reverse professionals watch in 2023? Give us your insights in the comments section below. And if you'd be so kind as to share this video on your Facebook or your LinkedIn profile, we appreciate that. And don't forget, we have a YouTube channel. You can also comment there, and be sure to subscribe and hit that like button if you appreciate the work and the effort we put into these videos each and every week. You can catch up on your most recent and the top reverse mortgage news stories by listening to our exclusive podcast, HECM World Weekly. Apple users can listen and subscribe on iTunes. That's a wrap for us. Be sure to come back next week in our December 26th edition. We're going to be featuring the top stories of 2022, top reverse mortgage stories that we covered here in HECM World. Perhaps we should call it the good, the bad, and the ugly. But we're going to be bringing that to you, so don't miss that. Until then, have a great week, and we'll see you soon.